It is Saturday, January 31st, 2026, the last trading day of the month, the last day of the week, and silver just crashed. Not a dip, not a correction, a crash. The price fell from $121 an ounce to $85. $36 vanished in a matter of hours. At the same time, gold fell from $5,600 to $4,890, $710 gone. If you are watching this feeling that knot in your stomach, I need you to pause, take a breath, watch this entire video. Because what I am about to show you does not add up. The numbers contradict the reality. The story flashing on your screen is a fiction. Silver crashed 30% this week, one of the most severe weekly declines in modern history. And yet right now, at this very moment, you cannot buy physical silver. The Perth Mint in Australia has suspended sales. The United States Mint has suspended sales. The Royal Mint in the United Kingdom is out of stock. Dealers in India are failing to deliver what they promised. Costco has purchase limits. Let me say that again, slowly. The price is crashing, but you cannot buy the product. Does that sound logical to you? Does that sound like any market you have ever seen? In a normal market, when the price of something falls, it becomes easier to find. Sellers emerge. Shelves fill. That is the basic law of supply and demand. But that law has been suspended. Here, the price is plunging while the physical metal is vanishing. The numbers on the screen are going down while the real world is running out. Something is broken, and by the end of this, you will see exactly what it is. To understand what happened today, you must first understand the official action. On paper, today was a routine market event. A large sell order hit the electronic exchange known as COMEX. This is the New York commodity market where futures contracts for silver are traded. The sell order was substantial. It came during the morning trading session in New York. The order was executed, and the price began to fall. This triggered automated selling algorithms. These are computer programs designed to sell when certain price levels are broken. They have no emotion, they just follow their code. The cascade of selling pushed the price lower, which triggered more algorithms. This is a flash crash in the digital realm. The official explanation will point to this technical event. They will talk about a large seller, maybe a fund liquidating a position. They will mention stop-loss orders and technical breakdowns. This is the surface story. It is clean. It is mechanical. It fits into the standard narrative of market volatility. But this explanation ignores everything that matters. It ignores the context. Why would a rational actor choose this moment, after a period of strong performance, to dump such a large quantity? Who benefits from this kind of violent move? The official action matters because it sets the price that the entire world sees. When you look up the price of silver, you see the COMEX price. This price is used to value inventories, to settle contracts, to mark portfolios. It is the benchmark, so when it crashes 30% in hours, it sends a shockwave. It creates headlines. It triggers margin calls for traders who bought with borrowed money. It forces leveraged funds to sell other assets to cover their losses. This official price becomes a self-fulfilling prophecy of fear. But the critical question, the only question that truly matters is this: what does that official price actually represent? Does it represent the value of a real, tangible ounce of silver in the physical world? Or does it represent the value of a digital promise in a closed electronic system? The action on the COMEX is a game played with chips. But we are about to see that the casino is running out of real prizes to award. Because the paper market and the physical market are now telling two completely different stories. The contrast could not be more stark. The paper market is the world of futures, options, and exchange-traded funds. It is a world of instant transactions, of billions of dollars moving with a click. In this world, silver is a ticker symbol. It is a number on a screen. It is a financial instrument used for speculation, for hedging, for complex trades. The vast majority of these paper contracts are settled in cash, not metal. They are promises about silver, not actual silver. This market is enormous in notional value, dwarfing the amount of real metal that exists. It sets the price everyone sees. Then there is the physical market. This is the world of mines, of refineries, of minting presses, of vaults, and of bullion dealers. This is the world where silver is a physical commodity. It must be dug up, processed, stamped, shipped, stored, and insured. In this world, you can hold the product in your hand. You can feel its weight. Over the past week, as the paper price collapsed, the physical market did something astonishing. It seized up. It froze. Around the globe, the channels for acquiring real metal slammed shut. The Perth Mint, facing what it called increasing worldwide demand and a large backlog, paused wholesale orders for nearly a month. The United States Mint suspended sales of its silver coins, and when they reappeared, the price to the public had skyrocketed far beyond the fallen paper price. The Royal Mint's website showed bars out of stock. In India, a cultural heartland for silver, reports emerged of dealers accepting payments and then failing to deliver the metal. They were defaulting. Even Costco, the bulk retailer, imposed limits on how much silver a customer could buy. This is the contrast. The paper market screams that silver is worth 30% less. The physical market whispers, through rationing, suspensions, and defaults, that it may be priceless. One market is drowning in digital sell orders. The other market is bone dry of real product. They have disconnected. The link between them, the mechanism that is supposed to keep paper and physical in harmony, has snapped. To comprehend why the physical market is dry, you must look at the vaults, the inventories, the supply-side data. This is the evidence. Let us start in Shanghai. The Shanghai Futures Exchange is a major trading hub in Asia. Their vaults hold physical metal to back their contracts. As of today, those vaults hold 455 metric tons of silver. That is approximately 14.6 million ounces. This number by itself is not alarming, but the movement is. In a single trading day this week, 27 metric tons were withdrawn, removed, taken out of the exchange's vaults. 27 tons is about 870,000 ounces of silver, gone in 24 hours. At that rate of withdrawal, the Shanghai vaults would be empty in less than 3 weeks. This is not slow leakage, this is a drain. Meanwhile, China has classified silver as a strategic resource and restricted its export. They are taking metal off the market and keeping it within their borders. Now look west to the COMEX vaults in the United States. The registered category, the silver specifically available to deliver against futures contracts, has been trending lower for years. It is a fraction of what it once was. The total stock in COMEX vaults is larger, but much of it is classified as eligible, held in storage, but not pledged for delivery. The cushion of readily available metal is thin. In London, the historic hub of bullion trading, vault holdings have also seen significant draws as metal flows east to satisfy demand in Asia. The data paints a clear picture. Visible, exchange-level inventories are under pressure. They are being drawn down. This is happening during a period of acknowledged structural deficit. For 5 consecutive years, global demand for silver has exceeded total supply for mines and recycling. The shortfall has been met by drawing down these above-ground stocks, these very vaults. The bathtub has been draining faster than the faucet can fill it, and now the data suggest we are nearing the bottom of the tub. The inventory buffer that for years allowed the paper game to continue smoothly is dwindling. When mints suspend sales, it is not because they want to. It is because their pipelines from refiners are constrained. They cannot source enough raw material to make new coins and bars fast enough. The supply chain is stressed from the mine all the way to the retail counter. The vault data is the hard evidence of a physical squeeze in progress, even as the paper price implodes. The natural question is, why would large banks or institutions participate in a market that appears so disconnected? What is their motive? It is crucial to approach this neutrally as a matter of mechanics, not malice. Banks and large trading firms operate in the paper futures market for a variety of legitimate business reasons. They provide liquidity, meaning they stand ready to buy and sell to facilitate customer orders. They hedge risks for clients involved in mining or industrial use. They run statistical arbitrage desks that seek to profit from tiny price discrepancies. Their motive, in a word, is facilitation and profit within the rules of the existing system. The existing system is a paper-based derivative system. It is built on the premise that only a tiny fraction of contracts will ever demand physical delivery. This allows for the creation of a vast liquid market where positions can be opened and closed with ease. Within this system, a falling price presents opportunities. A trader with a short position, a bet that the price will fall, profits when it does. If a bank's trading desk anticipates a wave of selling, whether from fund liquidations or technical breaks, establishing a short position is a rational, profit-seeking move. Furthermore, banks are often net short the silver market as part of their market-making function. They sell contracts to clients who wish to be long, and they manage that risk on their books. A sharp price drop can force those long clients to sell, allowing the bank to buy back its short positions at a lower price, locking in a profit. The motive is not necessarily a deep conspiracy to suppress silver. It is often simpler, to manage risk and generate trading profits in a market that is, by design, mostly financial. The system itself incentivizes behavior focused on the paper price, not the physical metal. The bank's goal is to win the paper game, according to the rules of the paper game. The fact that the paper game is becoming untethered from the physical reality is, from a narrow trading perspective, someone else's problem. Their job is to navigate the market that exists, not the market that should exist. This creates a profound asymmetry. The paper trader's motive is short-term profit on a screen. The physical buyer's motive is long-term possession of a tangible asset. These motives are on a collision course. This collision creates a specific psychological landscape for the retail investor, the individual watching the numbers flash red. If you are in this position, the emotional whirlwind is real and it is powerful. First comes disbelief, then confusion, then fear. You bought silver, perhaps, as a hedge, as savings, as insurance against uncertainty. You believed in its intrinsic value. Now the market is telling you that value has dropped by a third. The fear is not irrational. It is a programmed response to loss. You see your portfolio value shrink. You hear the panic in online forums. You are bombarded with headlines proclaiming a crash. The instinct to stop the pain, to sell, to escape is overwhelming. This is the psychology of capitulation. It is the moment when hope is extinguished and the only desire is to be out. The market masters understand this psychology perfectly. Large, rapid price moves are not just about money. They are about emotion. They are designed to trigger this specific response. The volatility is a test of conviction. If you are holding a physical piece of silver, you are now faced with a mental dichotomy. In one hand, you hold a coin. It is the same weight, the same metal it was yesterday. In the other hand, your phone screen tells you it is worth much less. Which do you trust? Your sense of touch or the digital ticker? The anxiety comes from this split. The paper world shouts that you are losing. The quiet, physical object in your palm says nothing has changed. This psychological tension is the battleground. The paper market is weaponizing fear, using volatility to separate investors from their mettle. It preys on the natural human tendency to follow the herd, to flee from danger. The empathetic truth is this: feeling scared in this situation is normal. It is what the system is engineered to produce. The question is whether you can separate that engineered fear from the factual reality of empty vaults, suspended mints, and soaring physical demand in other parts of the world. Your psychology is the target. Understanding the game is the first step in stepping off. So where does this lead? Let us explore scenarios, not predictions. This is not advice, but a mapping of possibilities based on the current disconnect. In one scenario, the paper market maintains control. The selling pressure continues or stabilizes at a lower level. The exchanges function, cash settlements occur, and the massive paper derivative system grinds on. In this world, the physical shortage worsens. Premiums for actual coins and bars over the paper price become permanently elevated and increasingly volatile. A two-tier market solidifies, a paper price for financial players and a much higher physical price for those who want the real thing. The mints operate on allocation, with long waiting lists. Physical silver becomes increasingly difficult for the public to acquire at any price. In another scenario, the physical reality intrudes upon the paper construct. The drain on exchange vaults continues until the COMEX registered category nears critically low levels. This raises the specter of a delivery failure, a situation where a paper contract holder demands metal and the system cannot provide it. This is a potential tipping point. Such an event would force a dramatic convergence. The paper price would have to spike violently upward to attract metal back into the system, or the exchange would have to change the rules, allowing cash settlement where physical was promised. Either outcome would shatter confidence in the paper pricing mechanism. A third scenario involves a slow, grinding recognition. Industrial consumers who need silver for solar panels, electronics, and other goods cannot source enough material at the paper price. They begin to pay whatever is necessary, creating a sustained bid in the physical market that eventually pulls the paper price higher, not through financial speculation, but through raw industrial necessity. The deficit is real, and it must be resolved through either much higher prices to discourage demand or a physical rationing that cripples industries. These are not fantasies. They are logical progressions from the current set of facts: a crashing paper price, vanishing physical inventory, and a growing chasm between the two. The conclusion is not a price target or a date. The conclusion is an understanding that the tension between a limitless paper world and a finite physical world cannot persist indefinitely. One will have to yield to the other. The only question remaining is which force proves to be the illusion and which one is the reality.